I'm Jay Young, CEO, founder, King Operating, fourth generation oil and gas. We came up with something new, which I'm really excited to share with you. It's not about drilling opportunities. It's about drilling opportunities, our investment approach, and why I feel like, COP3 is a compelling, investment vehicle for you. Why oil and gas? Why do we feel like oil and gas? And that's a great question. This is why should you invest in oil and gas? For multiple on investment, for income. If you look at the average, West Texas intermediate price for the last 5 years, the price is 71. For the last 10 years, it's 62. The last 15 years is 71, 33, and 20 years is 72. So what this shows you is, hey, oil prices may go down, but chances are really good. That's a great time to buy low, start drilling, buy low, buy pipe, get rigs out there, and this is a great time to participate in that. So that's a great deal. So um, also the demand, sorry. It's also the demand for oil and gas, which we see a lot of that right now. The demand is continuing to go up. You have data centers, energy infrastructure for these markets, which is really going to help out oil and gas. Wall Street Journal, I think it was yesterday morning, said that General Motors is pulling out of the electric EV business a lot, and so they're trying to get California to, California came up and said, "Oh yeah, hey, we want to make sure that we don't buy any gasoline, cars in the year 2035." They just came back and said, "Oh yeah, hey, we made a mistake." So they're going to have some cars. This is what a lot of our project is going to be, which is the average price of natural gas. It's moving up. It's going to increase. Demand's going up, and we're going to see this price at $4 or $5 for what we feel like that the average price of natural gas. A lot of oil wells will produce natural gas along with them. The projects that we have are probably about 70-30. They're probably about 70% natural gas, 30% oil. So they're weighted on the natural gas side, which is good. We like that. Why King? We use this investment vehicle to use for monthly distributions, a potential ROI multiple on exit, but also the ADD model, the acquire, develop, and divest. That's what we look for. That's what we strive for. We want the acquire, develop, and divest because we're not in it. We're not in it forever. We want to see a multiple on investment for you, the investor. So that's the number one thing is the investor. Well, maybe number 1, 2, and 3 is the investor. How can we protect your investment and how can we give you a good rate of return on that investment? Here's the leadership. That's right. Ramez mentioned my book, The Upside of Oil and Gas Investing. I wrote it a few years ago. And the reason why I wrote it is because I wanted people to know there is several ways to invest in oil and gas, and there is a good way and a bad way. And I explain this in my book, The Upside of Oil and Gas Investing. The majority of the wells or the majority of the deals that are out there, they have no upside. That's what I was talking to a guy in Chicago. Actually, I was in Chicago and I was at a conference and I asked an IRA, "Hey, what do you like about oil and gas and why do you do it?" And he said, "Well, we do it because the tax benefits, the monthly income, and we get our money back in about 3 to 5 years." And I said, "Man, where's the upside? Where's the upside to that?" And he said, "Well, there really isn't." He didn't know. He didn't know, and so I rewrote it, "The Upside of Oil and Gas Investing," which I will explain. So this is me, and this is me in my book, J.R. Young, and then we have the next slide, which will be our team of people that work here. We have geologists, engineers, geophysicists, landmen. These are the people that have it. Steve Mulligan, who's on the top left, is a petroleum engineer, actually a reservoir engineer in the petroleum industry, and very sharp guy, and he runs our team. All the oil and gas is he runs it. and then Kelly Duncan, who's drilled thousands of wells in the middle, and then on the right is Bill Phillips, and Bill is a landman. I know he doesn't look like Billy Bob Thornton, but he's pretty close, I guess. No, just kidding. But Mark Ayers, our geologist at the bottom left, Ryan Gores, engineer, Blake Gillespie is a geologist, and then Aaron Ledyard is also a landman. So we have a lot of staff, a lot of people. It takes a lot to drill wells. It's not just like you know, I don't say an apartment building. We take our model from an apartment building in the value add model, but it is so much more complicated and hard because you have to go drill wells, you have to have experts. It's 24/7, 7 days a week. I mean, it is when you're drilling, it's just an incredible amount of work and expertise that has to go in. It's not easy at all. But the returns are there, right? The returns are there as long as you find a good asset and you exit. YCOP 3, 2.8 to 1 is what our targets are. That means that, from $125 million, how do you get to there? And that's really, it's not complicated because we'll take wells and we'll go drill, 14 wells and purchase some sand plants with 20% of the income. And then what we'll do is we'll use that as leverage and go do that again in 2026, 27, rinse and repeat until the market's there to sell. We know the assets and we're setting up all the assets to sell at any time. I mean, meaning that there's one well that we've drilled, we leave enough room on each side of the wells, for a company to come in later on and drill. So we don't want to drill everything. We want some meat on the bone for our buyer. And so we may drill, 15 to 20 wells. Well, when we'll sell 20 wells and we'll sell 40 locations that a company can come in later on and drill. So that's good for them, and that makes it more attractive. It makes it a lot more attractive for them. So that's good in the space. Where's our assets and what are we doing? In the top left is the Bivens Ranch. There's over 60,000 acres, which is incredible. It's a multi-well horizontal drilling program, and we have 3D seismic, and it's a canyon line formation. The returns there, over 100% rate of return there. We're going to drill 4 wells this year in that area. Fisher County, which is down south of there, we've partnered with some wells. As a matter of fact, we already have revenue going out in that. So if you come in soon, then you'll start getting monthly revenue checks from those 4 wells that there's 3 wells that are producing income there. There is a 4th well that we're completing at this time. That's the 4th well. Vesuvius on the right bottom, Hockley County, 3,700 contiguous acres. Right in between 2 oil fields is where we were fortunate to get some acreage, and we've drilled 2 horizontal wells on there, and the wells should be on this week producing. So there you got 3 wells that we're already receiving revenue on. And there you also have 3 wells that we've drilled, and we are either we're in the completion stage of all 3 of those wells. And then you have 2 wells in the Bivens Ranch that we've drilled and not completed. So out of the wells that we've already hit all 8 wells. We're 8 for 8. We have 3 wells that are producing revenue checks. We have 2 wells that should be online. Well, we have 3 wells. Let's just say 3 wells on May, early June. And then we have another 2 wells that'll be on in July or August. That's 8 wells, and we have another 6 to go. So we're getting there on the income. And the income, like I said, is coming to the investors now. We also have the Mid-Continent section, which is 17,000 gross acres, horizontal and verticals, operates in 7 counties. We've got a lot of big position up there. We have a field office, and this is where a lot of oil and gas companies go to drill wells. They're good repeatability. You drill a well, you know pretty much what you're going to get after you drill the well. So the 4 R's is very, very important there, which we'll talk about in just a minute. Okay, that's our assets. In COP 3, here's the Anadarko Basin. This is a great area to drill for oil and gas because there's been so many vertical wells that have been drilled. A vertical well is one that's just been drilled vertically and down to, let's say, 8,000 feet. And that's it, 8,000 feet vertically, doesn't go horizontal. But you have so many wells out there. There's 300,000 wells that have been drilled up here. And in this area, you have 300,000 wells. A lot of those are vertical. So you know exactly how the horizontal is. And so all you got to do is just find out some really good, where the best vertical wells have been drilled, lease up some acreage and go horizontal. And we're going to do this repeatedly in this program, the next program. Our goal is to drill up in the sunlight area, that 60,000 acres, and also drill up the area in the mid-continent where we have a tremendous amount of acres, to drill up these two areas and divest in the next 2, 3, 4 years. I don't know when, because I don't know what oil and gas prices are going to be in the next 2, 3, 4 years, but we'll have some really great locations. And if somebody comes in, we will definitely divest our asset.
Jay, I got a question for you.
Yes.
Jason asks, what tier fields 1, 2, or 3 are working to drill at?
What is
Not
what again?
Okay, so Jason asks, not
Yep.
sure what he's referring to, but what tier fields 1, 2, or 3 are working to drill at? I'm a little confused on the question,
Yeah, well,
Jason.
there's tier one and tier
Oh,
two, three
okay.
acreage, and that's like in the Permian Basin. And we're drilling tier one acreage in the acreage that we have. So there's a lot of people, and one of the good things about commodity prices is there's a lot of, because the Permian Basin was producing, million barrels of oil, 10, 12 years ago. Now it's producing 6 or 7 million. So it's really gone up a lot. Well, the reason why is because there's been a lot of that tier one, which is the best rock imaginable in the Permian Basin, which has already been drilled. In our area, we're doing the same thing. We're producing in areas that are tier one acreage on both of our projects that we have. I hope that answers Jason's
Yeah,
questions,
awesome.
if I
Karen,
understand it
listen,
properly.
Karen, and there's a few IRA Club clients. You could tell there are clients because they understand self-directing. Does UBIT apply to the earnings? I'm just going to give you guys a couple seconds. Just give us, better yet, give Jay a couple seconds. He will be addressing UBIT. So just wait till a little bit closer to the middle to the end of the presentation.
Yes. I need to call my tax guy. I need to call my tax guy on the UBIT. But there is an answer. Yes.
Okay, awesome. And then I will address everybody on where to learn more about UBIT within our website. We actually completely revamped that page underneath our resource center. So when you're done, Jay and George presenting this, I will show our clients and newbies where to find that.
Good. I'm gonna send him a text right now. Can you tell me about UBIT? He's at that same conference that I was at, because there's a lot of tax questions there, so he's there. But I will get that answer to your question. If not, it will be on the website, as Rema says. So now, when we look for an oil and gas project, this is hopefully not too deep in the woods, so I won't get into this a lot or big time. But you want to look at 4Rs when you're looking at a field. There's a lot of different fields out there that you could participate in, and you don't want to, um, you want to make sure that the rate of return is there, your production is there, because people like to have wells that come on at 5, 6, 700 barrels a day. They want that production. They want the repeatability, making sure that it is, that you can do many, many wells over and over again. So it's repeatable, but also you want the running room. So if you have all four of these R's, rate of return, what's your internal rate of return on these wells that you're drilling, the rate of production, making sure that a public company wants, 4, 5, 6,000 barrels a day. They don't want 200. They want that big rate of production. They want the repeatability. They want to know, once they drill a well, what's the return going to be. We're proving that up for them. And also the running room. Can we get to 100 locations, 20, 30, 40 locations? Can we get there? How do we get there? They want to know they have the running room. Okay. Here's the our wells, the asset level well economics. On the top line, the Bivens project, that's that 60,000 acre ranch that we have. That's 11.2 million cubic, or I'm sorry, 11.2 million to drill and complete those wells. And then you have an EUR, which is your estimated ultimate recovery. Those wells should produce 2 million barrels of oil total. They'll come in at 1,129 barrels. The break even is 32. You don't get below 32 and drill those wells because you'll be trading out money for you'll put up 100% of the money, get 90% back if you go below $32 a barrel. But at $70 oil, that internal rate of return is 62.1%. So that's the big project. And then the second project is the Vesuvius Hockley. We don't have as many locations there, but you can see that it's 80.3% return, internal rate of return at 70. The break evens at 35. So there it's good. The Mid-Continent Anadarko, the one that we're working up 100 locations, those drilling costs are 5.5 million. It's almost 600 million cubic feet of gas. Is the oil and gas, and how much oil and gas? And then you have no, I'm sorry, that's 600,000 barrels. Pardon me. Yeah, that's included. That's MBOE, which is the 600,000 barrels of oil equivalent. So that's including oil and gas, 600,000 barrels. They come in at about 766 barrels a day. The break even on those is 42. It's these are more predictable. These Midcon and Anadarko wells more predictable. So you have to get it's God put them there, right? But they put them where you know the projects that are more predictable, uh, their returns aren't as good, but they're very predictable. So these returns break evens are 42, and then the internal rate of return at $70 oil is 62.4%. You show a company, hey, you can drill 20 wells here, you can drill 40 wells here, and you show them a 62% return. You prove that up to them, they'll give you all kinds of money for it. That's how you turn $125 million into, 300 to 400 million bucks. We're looking out for you, the investor, by doing this and doing this way. But that's how Jerry Jones and that's how Trevor Reese Jones, Ray Hunts, the oil and gas guys that have made it in the business, sold to public companies, and they have these public companies that have made tremendous amount of money and they have reserves and all that. This is how they've done it. So welcome aboard. The value of the project and how do you get from, like I said, how do you get to from 125 million to 348 million? What I like about this is this just shows every year your assumption is you drill 14 wells the first year and you get that underneath you, and then you drill 4 to 8 wells a year and just increase the value, increase that value. You're putting money back in the ground, you're putting money in your pocket. Everybody loves mailbox money. And so you put that money back in your pocket and you put money and you also reinvest those dividends and put a small credit facility together and leverage it and maybe get this thing up to 348, and then we're going to sell it and we're all going to make plenty of money. That's my goal. Me and George are the same. We're aligned for the same goals, and that is to increase the value of these assets, sell for you to make money. Yes, sir.
Jay, I need a favor from you. A couple clients are asking because I think they're watching it from either their cell phones or they might be at work and they are on their iPads. Is it any way possible that you can provide me the PowerPoint presentation and I could add it on as a hyperlink to the clients? A few people are asking that they can't see the actual numbers because they're too small. Is that
Yeah.
a possibility? I'm asking.
I'd give it to you in a second because you asked me, but I have to check with legal to make sure that everything's fine there. But
Okay, no
I'm
problem.
pretty sure it is. Are you talking
Okay.
right now?
Yeah, there's a
You
few
talking,
people that are asking, "Hey, I can't quite see. Can you repeat those numbers or what were the amounts? Or is there going to be a replay available?" And of course, everyone's going to get the replay. So I will just ask and confirm compliance purposes on George and Jay's side that they could share the PowerPoint presentation. And if they
We can
can, we'll take.
definitely share it. I'm assuming we can share it. I just don't know if I can. Do you want, if you send it to you right now, I can call Laura and ask her if she can email it to you. Do you want to do that?
No, it's not a big deal. We could just take
Okay,
it. We could continue the
never mind.
conversation,
Okay,
Jay, and then we could take that PowerPoint presentation so everybody could see those numbers again.
yeah.
All right. Hope that's
Okay,
helpful for
perfect,
everybody that's listening.
perfect. Yeah. Good. All right. We saw that. How do you build this up over time? How does Jerry Jones, how does those oil and gas guys, Jed Clampett? No, I'm just kidding. Jed Clampett was a royalty owner. He had nothing to do with drilling for oil and gas. They just found property on, or found oil and gas on his property. Shooting that shotgun. Shooting that shotgun. Anyway, here is the what kind of return does it look like that we can get if oil prices stay at 50? People are like, how much money if we sell are you going to make? Am I going to make? And, you know, because I mean, I don't know what the price of oil and gas is going to do. I feel very optimistic. Had an incredible, Dan Steffen did our opening at this conference I just finished. Um, he did it Sunday, 3 o'clock, and it was incredible the amount of information he had on why oil and gas is going to continue to go up. It's not going to come down. And he feels like it's going to be closer to the 80 than 50. So even at the $80 a barrel, that's a 2.95x. And at $50 oil, that's 2.56. So not a huge difference, but hey, there is money there. We don't leave money on the table. So let's sell if prices go up and we can prove up enough and show this to a good investor. Here's our oil and gas reduced tax burden. If you're participating as a GP, you could decrease your credit your monthly adjusted gross income. That's on the tax deductions. Also, a lot of people do it inside self-directed IRA because they want the space. They love the space and they want to participate on that. Income purposes, 9 to 14%. I think we could beat that really big, but I'm not going to sell it. I'm going to sell it to you at 9 to 14. And I'm very optimistic that we can do better, but I think George told me to put 9 to 14 here. Right, George?
Oh, yeah. I
Okay.
mean, 9 to 14 is very conservative.
Yeah, very, very conservative. And I think we could beat that all day long.
Right.
We're going to drill in great areas. I mean, that's it. Upside potential multiple on exit is a 2.8, as we mentioned. So that means that every $200,000 that you give us, we give you $560,000 back. That sounds like a pretty good deal. I like that. I like that for you, the investor, and especially for me because I'm an investor too. I've got a lot more than 200,000 in it, but I do want. I'm ready for my money to come back to me. Here's our track record. Right now, the 83% is the average tax liability, tax savings, and also this is the achieved monthly distributions, 7% a year. Like I said, we know what we did on the last fund, where we participated in some wells that had a higher risk tolerance, risk to reward, and we didn't work out. It didn't work out. So we're not going to do that again this time. Obviously, that's not who we are. We don't want to go drill the same wells again if they didn't work out properly. So we found a new area, and that's why we're in the Bivens Ranch, where Apache has drilled 18 wells. We have 3D, brand new 3D seismic. We're also drilling wells where Mewbourne has drilled wells up in the mid-continent area. They're all over there off of really good well control, vertical well control, and that's why I feel like we can beat that monthly distributions. Here's one that has the advantages of King. You know, an oil deal, a typical oil deal is you get the tax benefits, you get passive income. Most of the time they don't give you monthly distributions, you get quarterly. And they don't exit strategy, they all say it, but they don't know what an exit strategy is or what they need to do to get one. And that's what I was talking about earlier. You know, we sell 20, 30 wells that we've already drilled, $3 to $5 million a month in income, and then you have some extra wells that you've thrown in there, some acreage that's HBP held by production. That these that these public owners can drill in the future, and they like that, and that's why you do this. So we have a real exit strategy. Not only do we know what we're doing, but also how we should put this together. And like I say, anybody, this is how you subscribe. Get hold of George through the project, and like I said, you get your money in before the end of the month, then you can start receiving revenue checks sooner. And you can see how the oil and gas business works, and please join us. So we're having fun. It's a lot of fun to drill wells, and we appreciate we thank you for the interest.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.